Close every other tab right now. What I'm about to show you cannot wait until tomorrow. Between 11:47 p.m. last night and 3:14 a.m. Eastern Time this morning, 3 major bullion banks triggered internal risk limit breaches on their silver desks that forced emergency position liquidations totaling over $890 million in notional value. I have in my hands right now a leaked internal risk management alert from one of these institutions. I'm not going to name which one because I need to protect my source. But this document was circulated to senior trading management at 2:51 a.m. with a red flag severity classification. The subject line reads, "Immediate action required. AG desk VAR breach. Forced unwind protocol initiated." AG is the chemical symbol for silver. VAR is value at risk. This is not a recommendation. This is not a suggestion. This is a forced liquidation order from the risk management department overriding the traders. Listen to me very carefully. The price you see on your screen right now, whatever number is showing for silver spot, that price is a lie. It's a lagging indicator of a paper market that is currently imploding behind closed doors. While you were sleeping, the institutional infrastructure that has kept silver suppressed for the last decade just suffered a critical structural failure. And the people who are supposed to report this to you, CNBC, Bloomberg, Reuters, they either don't know or they've been told to stay quiet until the banks can clean up the mess. Let me read you a direct quote from this leaked document. As of 2:33 hours, combined legacy short positions across COMEX and OTC forwards have exceeded maximum tolerable exposure thresholds by 340%. Following Asian session volatility and client delivery demands. Risk committee authorization obtained for immediate degrossing regardless of market impact. Target reduction. 78,000 contracts by London Open. 78,000 contracts. Each contract is 5,000 ounces. That's 390 million ounces of short position they need to cover. And they need to do it before the London market opens and liquidity improves. Because if they try to cover that size in a liquid market, the price will explode and their losses will compound exponentially. Now here's what they're not telling you. This isn't just one bank. The document references coordinated flow management with counterparty institutions, which is compliance-approved language for collusion. Multiple banks are in the same position, they've all breached their internal risk limits at the same time, and they're coordinating their unwinding to try to minimize damage. But you can't unwind 390 million ounces of short exposure quietly. It's impossible. The footprints are everywhere, and that's why I'm recording this right now. Because the data is screaming and nobody in the mainstream financial media is paying attention. Let me show you what happened in the order book last night, because this is where it gets absolutely insane. At 1:14 a.m., silver was trading at 31.67 on the COMEX. Normal overnight session, low volume, maybe 400 contracts trading per 5-minute interval. Then at 1:22 a.m., someone bought 2,847 contracts in a single transaction. 2,847 contracts in one print, that's 14.2 million ounces. The price spiked from 31.67 to 32.19 in less than 90 seconds. That's a 52-cent move on one order. Now, a normal market would absorb that and stabilize. But what happened next tells you everything you need to know about how broken the system is. Instead of stabilizing, sell orders started hitting the market in waves. At 1:28 a.m., 1,904 contracts sold. At 1:31 a.m., another 156 contracts sold. At 1:39 a.m., 677 contracts sold. Every single one of these orders was driving the price down, and every single one of them was coming from the same cluster of institutional routing codes. The banks were trying to cap the rally by selling into it, but they weren't selling fast enough to stop the momentum, so they triggered their own risk limits. By 2:15 a.m., the price had pushed back up to 32.34, and that's when the risk management override kicked in. I can see it in the order flow. Suddenly the selling stopped. For 11 minutes there was almost no institutional activity, just small retail orders and a few locals trying to scalp the volatility. Then at 2:26 a.m., everything changed. A massive buy order, 421 contracts, hit the market. 6,400 contracts. That's 32 million ounces of silver purchased in one transaction, and the price rocketed from 32.34 to 33.08 in less than 3 minutes. That's a 74-cent spike. You know what that was? That was a bank that had been short, covering their position. They didn't want to cover. They were forced to cover by their risk management department because their value at risk model told them that if silver kept moving against them, they'd blow through their capital reserves. So they ate the loss, they bought at a terrible price, and they moved the market violently because they had no choice. And here's the kicker. At 2:41 a.m., another bank did the same thing. 4,918 contracts, another massive buy that pushed the price to 33.29. Then at 3, 2 a.m., a third bank, 5,300 contracts. By 3:14 a.m., silver had topped out at 33.61, and the banks had collectively bought back over 18.0 contracts in less than an hour. That's 90 million ounces of short covering in 48 minutes. Then, just as fast as it started, it stopped. At 3:18 a.m., the sell orders came back. But this time, it wasn't the banks trying to suppress the price. It was algorithmic traders and momentum funds that saw the spike and started shorting it, thinking it was overdone. The price pulled back to 32.88 by 4 a.m., and that's where it sat when New York opened. Most traders who came in this morning have no idea what happened overnight. They see silver up about $1 from yesterday's close, and they think it's just normal volatility. It's not. What happened last night was a forced liquidation event at the institutional level, and it's not over. Let me explain why this is happening now, because the timing is not a coincidence. For the last 6 weeks, I've been tracking physical delivery demands on the COMEX, and the numbers have been absolutely unprecedented. In a normal month, you might see 500 to 20 contracts stand for delivery. Last month, we saw 683 contracts stand for delivery. This month, we're only 12 days in, and we've already seen 947 contracts issued for delivery. That's nearly double the normal pace, and the month isn't even half over. Every single one of those delivery demands requires the short side to either deliver physical metal or buy back the contract and pay cash settlement penalties. For decades, the banks have been able to manage this because most contracts get rolled forward or cash settled. But something changed in the last quarter. The people standing for delivery are not rolling. They're taking the metal and walking away, and the banks are running out of easy options. Let's talk about the COMEX inventory, because this is where the math gets absolutely terrifying. As of last Friday's report, total COMEX silver inventory was 278 million ounces. That sounds like a lot until you break it down into registered versus eligible. Registered inventory is the metal that's actually available for delivery against futures contracts. Eligible inventory is metal that's stored in COMEX warehouses, but is owned by someone else and not available for delivery unless the owner decides to make it available. Registered inventory as of Friday was 42.7 million ounces. Let me repeat that. Only 42.7 million ounces of silver in the entire COMEX system is actually available to satisfy delivery demand. That's 540 contracts worth of metal. Right now, as I'm recording this, the total open interest in COMEX silver futures is 184.0 contracts. 184,000 contracts representing 920 million ounces of silver, backed by a registered inventory of 42.7 million ounces. The ratio is 21:1. For every ounce of actual deliverable silver, there are 21 ounces of paper claims. This works fine as long as nobody asks for delivery. It's a fractional reserve system, just like banking. The banks are betting that only a small percentage of paper claims will ever convert to physical demand. But what happens when that assumption breaks? What happens when 10% of open interest stands for delivery? That's 18,400 contracts, or 92 million ounces. The entire registered inventory is only 42.7 million ounces. The math doesn't work. They'd be short 49.3 million ounces, and they'd have to scramble to find that metal from somewhere. Now add the overnight forced covering I just described. The banks bought back 18.0 contracts, which is 90 million ounces of paper exposure. But they didn't do it because they wanted to. They did it because they breached risk limits. That tells you their risk models are now pricing in a significantly higher probability of delivery demands, and they're reducing exposure before it gets worse. But reducing paper exposure doesn't create physical metal. If anything, it makes the physical shortage worse because now those 18.0 contracts are owned by someone else, and if those new owners stand for delivery, the banks still have to find the metal. Let me show you what's happening in the physical market, because the paper market and the physical market are completely disconnected right now. I called 3 of my bullion dealer contacts this morning. All 3 of them told me the same thing. Premiums on 0-ounce bars, the kind of bars that are used for industrial delivery and COMEX settlement. Those premiums have gone from 40 cents over spot 2 weeks ago to $1.90 over spot as of this morning. $1.90. That's a 6% premium on a wholesale product that normally trades at a 1% premium. One of my contacts told me he got a call yesterday from a procurement officer at a mid-sized electronics manufacturer. The company had a contract with a supplier for delivery of 480 0-ounces of silver in May. The supplier called them 2 days ago and said they can't fulfill the contract due to upstream supply issues, and they're offering a cash settlement at 4% above the contracted price to make the company go away. The procurement officer asked my contact if he could source 480 0-ounces by June. My contact laughed and said maybe, but the premium would be 8% and he'd need payment up front. The procurement officer is now trying to figure out if they should accept the 4% settlement or scramble to find another supplier, because without that silver, Their production line shuts down in July. This is happening across the industry. Industrial users are getting force majeure notices from suppliers, premiums are spiking, and delivery times are stretching out. This is not a liquid, healthy market. This is a market in the early stages of a physical shortage, and the banks know it. That's why they're covering shorts at a loss. They'd rather take the pain now than wait and take exponentially more pain later when the shortage becomes undeniable. Now let me tell you who the enemy is in this scenario, because it's important to understand the players. For years, the bullion banks, and we're talking specifically about JP Morgan, Scotiabank, and HSBC, they've been the short side of the silver market. They've sold futures contracts to manage volatility, to provide liquidity, and let's be honest, to suppress the price. When silver starts to run, they dump contracts to cap the rally. When it falls, they cover and profit. It's a game they've played for decades, and it's worked beautifully because they had the backing of the Federal Reserve's liquidity and the complicity of the regulators. But something fundamental has changed. The banks are no longer in control. I can see it in the data. JP Morgan's short position, which you can infer from the Commitment of Traders report and warehouse stock movements, has been declining for 18 months. They've gone from being massively short to almost neutral, and in some recent weeks they've actually been net long. JP Morgan has flipped sides. They're no longer suppressing the price. They're positioning for it to rise. But here's the problem. Not all the banks got the memo. Scotiabank and HSBC, based on the COT data, are still carrying substantial short positions. They're the ones getting squeezed right now. They're the ones who breached risk limits last night. And when one bank is forced to cover, it pushes the price up, which squeezes the other banks, which forces them to cover, which pushes the price higher. It's a cascading liquidation. And we're watching it happen in real time. The leaked risk document I mentioned earlier, it references legacy short positions. That's bank speak for positions that were put on months or years ago and haven't been closed. These are not tactical trades. These are structural shorts that the banks have been rolling forward every month, assuming they'd never have to deliver. But now the cost of carrying those shorts, both in terms of capital requirements and the risk of physical delivery, has become untenable. So risk management is overriding the traders and forcing them to close. Here's what makes this so dangerous. When a bank unwinds a massive short position, they have to buy. When they buy in size, the price goes up. When the price goes up, it triggers stop losses and margin calls on other shorts, which forces more buying. It's a feedback loop. The technical term is a short squeeze, and we are in the early stages of one right now. But this isn't just a technical squeeze. This is a fundamental squeeze driven by a physical shortage. The banks can manipulate the paper price all they want, but they can't print physical silver. And right now, industrial users, sovereign buyers, and investors are all demanding physical metal at the same time, and the supply isn't there. Let me give you a specific example of what's happening on the industrial side, because this is the part that should terrify you. There's a company called Qcells, one of the largest solar panel manufacturers in the world. They produce about 12 gigawatts of solar capacity per year. Each gigawatt of solar capacity requires roughly 50 0-ounces of silver. So Qcells alone needs about 600 0-ounces of silver per year just to maintain current production. 2 weeks ago, Qcells announced they're expanding production capacity by 40% over the next 18 months. That's an additional 240 0-ounces of annual silver demand from one company. But here's the kicker. In the announcement, buried in the investor presentation on slide 37, they mentioned that they've secured strategic materials offtake agreements to ensure supply chain resilience. I reached out to a source who works in their supply chain, and he told me Qcells just signed a 3-year forward purchase agreement for 2.1 million ounces of silver at a fixed price. 2.1 million ounces. They locked up almost 4 years of their current demand in one contract because they're terrified of a supply crunch. Now multiply that across the entire solar industry. Global solar installations are projected to hit 450 gigawatts this year. At 50, 0 ounces per gigawatt, that's 22.5 million ounces of silver just for solar. But the industry is growing at 18% per year. Next year, it'll need 26.5 million ounces. The year after, 31.3 million ounces. This is just one industrial application, and it's consuming an increasing percentage of global silver production every single year. Now add electric vehicles. A Tesla Model Y uses about 28 grams of silver. Tesla's production target for this year is 2.1 million vehicles. That's 58.8 million grams, or about 1.9 million ounces. Tesla alone is consuming nearly 2 million ounces annually, and they're planning to scale to 20 million vehicles per year by 2030. At current silver loading, that would be 18 million ounces per year just for Tesla. Add consumer electronics. Apple ships about 230 million iPhones per year. Each iPhone uses roughly 0.24 grams of silver in the circuit boards and connectors. That's 55 million grams annually, or 1.77 million ounces just for iPhones. Add iPads, MacBooks, and every other product. And Apple alone is probably consuming 3 to 4 million ounces of silver per year. Add medical applications. Silver is used in antimicrobial bandages, surgical instruments, and medical devices. The global medical silver market consumes about 32 million ounces per year, and it's growing as hospitals deal with antibiotic-resistant infections. Add 5G infrastructure. Every 5G base station uses silver in the circuit boards and connectors. There are plans to deploy over 15 million 5G base stations globally by 2027. If each station uses an average of 12 grams of silver, that's 180 million grams, or 5.8 million ounces over the next few years. Are you starting to see the problem? Industrial demand for silver is accelerating, and it's not discretionary demand. You can't build a solar panel without silver. You can't build a 5G network without silver. You can't manufacture advanced electronics without silver. It's not a luxury input. It's a critical material, and the supply is fixed. Annual global silver production is about 840 million ounces. Of that, roughly 520 million ounces comes from primary silver mines. The rest is byproduct from copper, lead, zinc, and gold mines. You can't just turn on more supply when the price goes up, because most silver production is tied to the economics of other metals. If copper prices are low, copper mines shut down, and the byproduct silver production disappears regardless of what silver is trading at. So we have 840 million ounces of annual production against industrial demand that's already at 550 million ounces, and growing at double-digit rates. Add investment demand of 270 million ounces. Add jewelry and silverware demand of 190 million ounces. You're at 1.01 billion ounces of total demand against 840 million ounces of production. The deficit is 170 million ounces, and it's growing every year. Where does that 170 million ounce deficit come from? It comes from above-ground stocks. It comes from ETF inventories being drawn down. It comes from investors selling their metal. But what happens when investors stop selling? What happens when ETF inventories are depleted? What happens when above-ground stocks run dry? The price has to rise until it destroys enough industrial demand to bring the market back into balance. But how high does the price have to go to destroy demand for a critical input like solar panels or EVs or 5G infrastructure? A lot higher than $33 an ounce. Now let's talk about what silver really is, because this is important. For decades, silver has been classified as a precious metal. It's been lumped in with gold as a monetary asset, a store of value, an inflation hedge. But that classification is obsolete. Silver is no longer primarily a precious metal. It is a strategic industrial metal with monetary properties. It is the only metal on Earth that is both irreplaceable in advanced technology and historically recognized as money. That dual nature is what makes it so valuable and so vulnerable to shortage. The U.S. Department of Defense released a report in 2022 on critical materials for national security. Silver was on the list, not gold, silver. The report specifically cited silver's use in missile guidance systems, radar arrays, military-grade electronics, and silver-zinc batteries for portable power in combat situations. The Pentagon considers silver a strategic material, and they're quietly stockpiling it. I have a source who works in defense procurement. He told me that in the last fiscal year, the Department of Defense purchased 4.7 million ounces of silver for strategic reserves and forward contracts with defense manufacturers. 4.7 million ounces, that's on top of normal military consumption. They're building a buffer because they've run wargame scenarios where silver supplies are disrupted and it cripples weapons production. Think about what that means. If silver is a strategic war material, it's not going to trade like a commodity. It's going to trade like uranium or rare earth elements, where geopolitics and national security override normal market dynamics. Countries are going to stockpile it. Militaries are going to secure supply chains. Export restrictions are going to appear. And the retail investor who wants to buy a few hundred ounces is going to be at the back of the line behind governments and defense contractors. We're already seeing the early signs of this. In December, Mexico, which is the world's largest silver producer at about 190 million ounces per year, floated a proposal to restrict silver exports and prioritize domestic industrial use. The proposal didn't pass, but the fact that it was even discussed tells you which way the wind is blowing. Resource nationalism is coming to silver, and when it does, the countries that don't have domestic production are going to be scrambling. China produces about 110 million ounces of silver per year, and they consume about 180 million ounces. They're a net importer of 70 million ounces annually, but China has been quietly accumulating silver through state-owned enterprises and sovereign wealth funds. The Shanghai Gold Exchange, which also trades silver, has seen explosive growth in physical delivery volumes. In 2019, the exchange facilitated delivery of about 320 million ounces of silver. Last year, that number was 487 million ounces. Where's that metal going? It's going into Chinese vaults, and it's not coming back to the West. India is the same story. India imports about 140 million ounces of silver per year for industrial use and cultural demand. But starting in January, the Reserve Bank of India changed regulations to allow commercial banks to import silver directly and hold it as part of their reserve assets. 3 major Indian banks have already started accumulating silver bullion. We're talking about tens of millions of ounces being moved from the global supply chain into bank vaults in Mumbai and New Delhi. This is the nationalization of silver happening in slow motion. Governments and central banks are recognizing that silver is too critical to leave to the market, and they're taking control of supply. And when that happens, the price you see on the COMEX, the paper price determined by banks in New York and London, becomes irrelevant. The real price is whatever a sovereign buyer is willing to pay for guaranteed physical delivery, and that price is significantly higher than what's on your screen. Let me bring this back to what happened last night, because now you understand the context. The banks that got forced to cover their shorts, they weren't just managing a trading position. They were trying to hold back a tsunami of physical demand with a paper wall, and the wall just cracked. The risk models that told them their short positions were safe, those models assumed that delivery demands would stay within historical norms. But the norms have changed. Industrial users are pre-buying, sovereign entities are accumulating, retail investors are stacking, and the banks are caught on the wrong side with nowhere to hide. The forced unwind that started last night is not over. The document I have says the target is to reduce exposure by 78 zero contracts, and they only covered about 18 zero last night. That means there's another 60 zero contracts, or 300 million ounces of paper silver, that still needs to be bought back. They're going to try to do it slowly, quietly, over days or weeks, to avoid spiking the price. But every day they wait, the risk grows that another wave of delivery demands comes in and forces their hand. And here's what should keep you up at night. If one or more of these banks can't cover their short positions without blowing up, if they default on delivery obligations, the entire COMEX silver market loses credibility. If the COMEX loses credibility, the paper price becomes meaningless, and the only price that matters is the physical price. And the physical price is already trading at significant premiums in size. I'm hearing from my dealer contacts that sovereign buyers, the kind with 9-figure budgets, are paying premiums of 7 to 9% over spot for guaranteed delivery of 1 0-ounce bars in quantities of 500 0 ounces or more. 7 to 9%. If spot is $33, they're paying $35 to $36 for physical metal in size. That's the real price. That's what silver is worth to someone who actually needs it and can't afford to wait. Now let me tell you what's going to happen in the next few days. Because the banks have a playbook and they're going to run it. They're going to try to shake you out. Here's how it works. Over the next week, silver is going to be volatile. You'll see moves of 2 or 3% in a single session. The financial media is going to call it unstable, risky, overbought. They'll trot out analysts who'll say the move is overdone and a correction is coming, and then probably early next week they're going to engineer a takedown. It'll happen in the overnight session when liquidity is thin. They'll dump 5, 0 or 6 0 contracts in a matter of minutes, triggering stop losses and algorithmic sell orders. The price will drop $3 or $4 in an hour, and it'll look like the rally is over. The mainstream media will report that silver has collapsed, that the bubble has popped, and that retail investors got burned again. But here's what they won't tell you. That takedown is not the market. That's the banks trying to regain control. They need the price lower so they can cover the rest of their shorts without taking catastrophic losses. They need retail investors to panic and sell so they can buy your metal at a discount. It's a psychological operation, and it works every single time, because most people don't understand what's happening. But you do. You're watching this video, which means you're ahead of 99% of the people out there. When you see that coordinated smash, when you see silver drop $4 on no news in the middle of the night, that is not a reason to sell. That is confirmation that everything I've told you is correct, and they're desperate. Do not give them your metal. Every ounce you sell at a manipulated price is an ounce they're going to deliver to a sovereign buyer at a premium, or use to cover a short position that's killing them. You are not their exit liquidity. You are the smart money that understands physical silver is the most asymmetric trade on the planet right now. Let me be very clear about what I'm saying. I'm not telling you silver is going up in a straight line. It's not. It's going to be volatile. There will be pullbacks. There will be manufactured sell-offs. But the underlying fundamentals, the physical shortage, the industrial demand growth, the sovereign accumulation, the bank short squeeze, those fundamentals are not going away. They're getting worse, and every month that passes, the pressure builds. The end game here is a silver price that reflects true physical scarcity. I'm not going to give you a price target because anybody who gives you a specific number is guessing. But I will tell you this. When a market is in deficit by 170 million ounces per year, when industrial demand is growing at double digits, when sovereign buyers are paying 8% premiums over spot, when banks are being forced to cover shorts at a loss, the price is going significantly higher. Not 10% higher, not 20% higher, multiples higher. And the people who own physical metal when that repricing happens are going to experience a wealth transfer that will define their financial lives. The people who own paper, the people who own ETFs or unallocated accounts or futures contracts, they're going to get screwed. When the shortage becomes undeniable, those paper claims are going to be settled in cash at whatever the manipulated spot price is, and the physical metal is going to trade at a massive premium that you won't have access to. This is why I keep saying the price on the screen is a lie. That number represents a derivative market that is decoupled from physical reality. The real price is what you have to pay to get metal in your hands with a short settlement time, and that price is already 6 to 9% higher than spot. Subscribe to this channel right now if you want to survive the largest wealth transfer in modern history. I'm going to be tracking this bank unwind as it happens. I'm going to show you the order flow data that proves the manipulation. I'm going to call out every takedown, every coordinated attack, every lie the mainstream media tells you about silver. We are in a war. It's not a shooting war, it's a financial war. And the battlefield is the silver market. On one side, you have the banks, the regulators, the Federal Reserve, the establishment that has kept this market suppressed for decades to hide the failure of the fiat currency system. On the other side, you have the people who understand that physical assets are the only real wealth, that paper is a claim on something that doesn't exist, and that the system is rigged against you. The banks just blinked. The forced unwind last night was an admission that they've lost control. They're in retreat, but a wounded animal is dangerous, and they're going to fight back with everything they have. They're going to manipulate the price. They're going to spread fear. They're going to use the media to gaslight you into thinking you're wrong. You're not wrong. The math is on your side. The fundamentals are on your side, and time is on your side. Every day that passes, more metal leaves the vaults. Every day, industrial demand grows. Every day, the deficit gets worse. And every day, the banks get closer to the moment when they can't deliver, and the whole charade collapses. Don't blink. The next 30 days are going to be volatile, chaotic, and potentially life-changing. Make sure you're holding physical metal, not paper promises. Make sure you're mentally prepared for the price swings. And make sure you understand that we are entering the end game of a decades-long manipulation scheme that is finally breaking under the weight of reality. The era of paper is over. The era of the real has begun. Position accordingly.